Hello and welcome to another TLDR Explains video about the ongoing Wall Street Bets GameStop saga. Earlier in the week, we discussed why a lot of people were shorting GameStop stock, and why Reddit might make them regret it. A lot's happened since then, so we're going to take a look at what some people have been calling major market manipulation, and try our best to explain in relatively plain English what's actually just happened. The vast majority of the people who watched our last video on this topic weren't subscribed to the channel, which means they might have missed this video altogether. If you want to make sure that doesn't happen to you, subscribe to the channel so that you can be updated not only on the GameStop saga, but on other US political stories, like all the executive orders Biden signed in his first 24 hours, and the debate around DC statehood. Thanks for your support. Okay, so as in our last video, a quick disclaimer before we start. This whole story is very financy, so we're going to try and make it as digestible as possible for a general audience. That means we might skim over some super financy stuff a bit quickly, but please don't hate us for it in the comments, we're just trying to make this easy for everyone. A quick recap though. Over the last couple of weeks, Reddit users bought up GameStop stock to try and force a short squeeze, profiting at the cost of some big hedge funds. If you're out of the loop on this one, then you'll want to watch our earlier video, otherwise a lot of this isn't going to make much sense. Anyway, on Thursday, a whole load of trading platforms, including Robinhood, went down, blocking users from buying GameStop stock, and a couple of other popular stocks that investors had shorted. Obviously, with fewer buyers, the price dropped suddenly and dramatically, but it has since recovered. Regardless, this decision to block people from buying the stock has led to some accusing them of market manipulation, and almost immediately led to class action lawsuits being filed. Now, to properly understand this story, you're going to need a slightly more in-depth understanding of the stock market, and how commission trading platforms like Robinhood make their money. To explain this, we're going to revert back to the apples analogy we used in the last video. So at its most basic level, the stock market is just people buying and selling apples. But there are three things worth understanding that keep everything moving super smoothly. Firstly, there's clearing brokers. Clearing brokers are the people who are actually at the apple market, doing the trading. You're at home and you instruct your clearing broker to buy some apples. And these are essentially the apps you use on your phone like Robinhood or Freetrade. Secondly, there's clearing houses. Clearing houses are the places where the two clearing brokers actually do the trade. The clearing house is like a market stall with a police officer standing over it, making sure that the trade is actually what was agreed. Now, this is pretty easy when it comes to the buying of apples, because the policeman just checks that clearing broker A has an apple and clearing broker B has $1. But in real life, it becomes a bit more complicated for the clearing house and police officer when we're actually talking about the stock market. This is because, continuing with the apple analogy, there are too many apples being traded too fast to keep up with all of them in real time. So instead, the policeman lets you trade before it's actually happened. This is why you can buy stocks from your Robinhood app at home immediately, but the trade itself is settled later. Normally, each clearing firm has 2 business days to make sure that you really do have the $1 or apple you promised, get it off you, and then show it to the policeman. Now, this 2-day lag entails a real risk for that police officer, because sometimes you agree to buy an apple for $1, then when the clearing firm phones you in a day's time and says, "So where's that dollar you had?" you say, "I had it yesterday, but now I'm bankrupt." This means that the trade can't be settled, and you've defaulted on your side of the trade, so the person selling the apple is left penniless. To accommodate for this risk, the police officer requires that the clearing broker puts up collateral, usually around 2%. So basically, your broker has to give the police officer 2 cents on day one, as a form of collateral or insurance. The third and probably most important aspect are market makers. Now, market makers are appointed by the stock exchange itself, so in this analogy they're appointed by the policeman, I think. Basically, market makers buy and sell spare stock to provide liquidity. This means that when you want to buy an apple, you can always buy an apple off the market maker, even if no one else is willing to sell one at that precise moment. Equally, if you've got an apple to sell, the market maker will buy it. Now, the market maker is obviously taking a bit of a risk here, because he's obliged to buy the apple. even if there's no one who wants to immediately buy it from him. This means that if the price of apples drops suddenly, the market makers sat holding a bunch of worthless apples. So to counteract this risk, the market maker makes their money by what's called spread. Basically, they pay a little bit less for apples than what they sell them for. It's not a big difference. Market makers might buy at $1 and sell at $1.01, but if 1 million people make that trade, the market maker makes $10,000. So in this analogy, the market maker is someone desperately running around the market at super quick speeds, buying and selling loads of apples. The market maker you need to know about in this real life situation is called Citadel, and they're authorized by the New York Stock Exchange. So enough about apples, let's get to the real events of this week. Basically, at 10 a.m. on Thursday, most brokers, i.e. Robinhood and Co., halted buying of certain US stocks, including GME and AMC. This meant that most everyday average Joe retail investors couldn't buy the stocks, but hedge funds who needed to cover their short positions could. Because there were less buyers, the stock price fell from a peak of $450 to a low of $130. Now this looked incredibly convenient for the hedge funds and prompted a complete uproar. But what actually happened? Well, according to an interview with Webull CEO Anthony Dyer, this was because the clearinghouse, DTCC, put up the collateral requirements to 100%. Basically, the police officer got anxious about people trading apples they didn't have, and told brokers that they'd have to pay up fully in advance. This is presumably because people who shorted the stock, like Melvin Capital, desperately needed to buy it, but GameStop was so expensive, there was a real chance that they'd go bankrupt. This new collateral requirement seemingly stopped Robinhood and Webull from letting their users buy shares, because A, these companies don't have deep enough pockets to pay 100% collateral upfront for all of their users, and B, it's super risky. Basically, imagine Melvin Capital or some other short position tells their broker to buy 100,000 apples. The policeman says, sure, but you need to pay in full and right now. But right now is before the brokers actually got Melvin's money, which would happen in 2 days' time. So unless the broker's got $100,000 sitting about, he can't put up the collateral. And also, it's super risky for the broker, because if he puts down his own $100,000 and then Melvin Capital says, sorry mate, we don't have the money, then they've lost $100,000. So, to mitigate the risk, the broker just stops trading, which is what happened on Thursday. Now, this all seems innocent and checks out at first glance, but there are some suspicious wrinkles in this story. Firstly, the other person set to lose a lot of money in this was market maker Citadel. This is basically because of futures contracts they held, which are nearly impossible to explain using apples. But the long and short of it is, Citadel promised a lot of people GME apples when they were cheap, but they suddenly became super expensive and super rare, which clearly isn't a good thing. On top of that, Citadel also invested $2 billion into rescuing Melvin Capital earlier this week, when they nearly collapsed due to their short positions in GameStop. So, Citadel held a lot of futures that were getting increasingly expensive, and they just bailed out a company who would lose even more money if the price of GameStop went higher. Basically, however you look at it, Citadel desperately needs the stock price to fall. Here's the real controversy though. Many brokers, like Robinhood, have a deal with Citadel to sell them user data. In 2020, 35% of Robinhood's revenue came from selling data to Citadel. So some people began to speculate that Citadel put pressure on Robinhood to block average people trading in order to make the stock price fall and protect their business and hedge funds. On top of that, Citadel are also quite well connected in the US Treasury. In fact, Janet Yellen, the Treasury Secretary, has been paid $800,000 in speaking fees from Citadel over the last 2 years. In the apples analogy, this would be like if the market maker was losing money, but the other brokers needed him to make their businesses profitable. And he paid the chief constable of the police force $800,000 in speaking fees. Obviously, it looks suspicious if the policeman and all the brokers suddenly stop trading when the market maker, who's got some clear leverage here, starts losing money. Now, we're not saying anything for certain, and Citadel certainly deny this. We're just explaining why Redditors and politicians alike see this as suspicious. And because of this, it's basically the only thing over the last year that's unified politicians across the aisle, so I guess there's a silver lining. When else would you see Ted Cruz saying that he fully agrees with AOC? With politicians seemingly universally furious with Robinhood for blocking average people from trading, it'll be interesting to see what happens next. Not only how the market reacts, but how politicians and Congress do too. With high-level hearings and meetings scheduled not only to discuss this event, but the entire operation of the stock market, there's a real chance this one event sparked by Reddit could lead to huge, wide-scale changes. Make sure you subscribe to the channel, because we'll be continuing to explain this in the days to come. Now that we've got all the apples out of the way, next time we can run you through the politics, the legality, and any impending lawsuits. So make sure you subscribe so you see it when it happens. Special thanks to our Patreon backers who make videos like this one possible. And if you want to see your name at the end of videos, then you too can back us on Patreon. The link to that's in the description.